Assalamualaikum warahmatullahi wabarakatuh. Today, we are from group number 5, representing about FGV Holdings Berhad. Our group consists of 5 persons which are Ainur Akilah binti Mat Bakri, Atikah binti Shrizal, Nur Adira Amani binti Hamizat, Siti Nur Aisyah binti Badlisham, and Umi Najwa binti Rosli. We will start the presentation with Part A of Segmental Report Mfrs 8. Hi, I am Siti Nur Aisyah, will be the first presenter for this presentation. Felda Global Ventures Holdings Berhad, or to be short is FGV Holdings Berhad. It is an affiliate of the Federal Land Development Authority, or known as Felda. FGV Holdings was founded 40 years ago at 19 December 2007 and their headquarters at Kuala Lumpur, Malaysia. With operation worldwide, FGV produces oil palm and rubber products, oleochemical and sugar products with material resourced from Felda colonies throughout the country. FGV is supported by a strong workforce of more than 45,000 people. FGV are focused primarily on 3 core business sectors which are plantation, sugar, and logistics. Next is the management approach. Firstly, let's take a look at the factor to consider having a segment reporting. The first factor is nature of the business products or activities. There are 5 characteristics under these factors, which are the nature of the products and services, the nature of production processes, the type of customer for the product or services, the method used to distribute the product or provide services, the nature of regulatory environment. Next is existence of manager responsible for the activities. As you guys know, managers are responsible for the process of getting activities completed and achieving the firm's goal through the execution of 4 basic management functions. The 4 basic management functions are planning, organizing, leading, and controlling. Last management approach is information presented to the board of directors. The information provided to the Board of Directors, when it does not be considered the CODM, it may indicate at the level which our overall performance is assessed and decisions are made. Next, we move to the type of segment. Basically, FGV use 2 types of segment which are business segment and geographical segment. Firstly, business segment. Business segment is a unit of the entity that is engaged in providing products and services to consumers. The core business that run by FGV as below. For example, FGV have plantation, sugar, logistic, and other segments. So, let's take a look at the first one, which is plantation. Under plantation, we can be more specific into upstream, downstream, R&D, and fertilizer. Plantation estate activities including cultivation, harvesting, and production of fresh fruit bunches, processing of FFB into crude palm oil and palm kernel. Other operations including research and development activities, fertilizer processing, rubber processing and production, sale of planting materials, and security. Next, for sugar, they have sugar refining, sales and marketing of refined sugar and molasses. Thirdly, logistics, which are bulking and transportation facilities and services. Last but not least, other segments which include engineering services, information technology, and travel. Moving on to the last segment, which is geographical segment. Geographical segment is component of an entity that is engaged in providing products or services to consumers within a particular economic environment. FGV has separated their geographic segment based on regions such as India, China, Pakistan, United States, and Canada. That's all from me. Thank you.
My name is Atikah binti Shrizal and I will explain the process to identify the reportable segment and non-reportable segment. If a particular product or service of the entity is significant and constitutes as an identifiable business in which the entity operates, then the product or service would be reported as a separate operating segment. Not all operating segments need to be separately reported. Operating segments are only required to be reportable if they exceed the quantitative thresholds of 10% and 75% of the entity's total revenue. 2 or more operating segments may be combined and reported as one if certain conditions are satisfied. In order to be considered as reportable segment, it must meet one or more of the following quantitative thresholds. First, revenue. The company's reported revenues from external sales and inter-segment sale is 10% or more of the combined revenues of all operating segments. Or second is profit. The absolute amount of the segment reported profit or loss is 10% or more of the greater of the combined reported profit of all segments reporting profits or the combined loss of all segments reporting losses. Third, asset. The segment assets are 10% or more of the total asset of all operating segments.
Thank you, Atika, for the great explanation. Hi, I am Nur Adira Amani binti Hamizat. I will be talking about the 10% rule as well as the 75% rule. What if the 10% threshold criteria is not met? It can be designated as a reportable segment despite its size. It can be combined with other similar segments that are also below threshold or significant for the purpose of meeting the 10% threshold test, or it is included as an all other segments category. However, even if the segment meets the 10% threshold test, it still needs to be tested to comply with the 75% rule. To be precise, the entity shall ensure that the total external revenue attributable to those reportable segments is at least 75% of the overall revenue of the business. If the 75% criteria is not attained, further reportable segment, even if they do not satisfy the 10% requirement, should be identified until at least 75% of the entity's total external revenue is included in its reportable segment.
This table shows the calculation of the 10% threshold using revenue basis. We can see that there are two reportable segments that exceed 10% of total revenue, which is upstream in plantation with 60.59% and downstream in plantation with 26.27%. For geographical segments, we can see that there is only one reportable segment that exceeds the 10% threshold test by 67.8%, which is from Malaysia. After determining the reportable segments, the entity should ensure that the total external revenue attributable to those reportable segments is at least 75% of the entity's total revenue.
Moving on, based on the slide, for the business segment, it is proven that it passed the 75% threshold test, as the percentage is 84.28%, which passed the 75% of the entity's total revenue, which indicates that the reportable segment will remain the same and there is no other reportable segment will be identified. Here is the illustration of the new segmental report, and there are no changes made. As for the geographical segment, it did not qualify the 75% threshold rule, as the percentage is only 67.80% of the total external sales generated by the reportable category. As a result, even if the segment meets the 10% threshold test, it must be recognized as other reportable segment until the 75% criteria is reached. Based on the illustration, the extra segment, which are India and Asia segments with the greatest external revenue, shall be included and defined as a reportable segment, since there will be increment when it is combined from 67.80% to 79.67%. The other four non-reportable geographical segments are aggregated and given as other segments. Here is the illustration of the new geographical segmental report, and the changes have been made, and as we can see, Asia and India is now a reportable segment. Proceeding to the next slide, there are always advantages and disadvantages. The advantages of segmental report is it gives a better understanding of the financial statement. Segment reporting enables FGV shareholders to gain a better understanding of the variances that may affect overall numbers. For instance, the report shows where those earnings are coming from and can help shareholders to determine whether the earnings are sustainable or instead. Hence, this reporting is intended to assist the investor. Next is the transparency is displayed in the segmental reporting. Transparency is one of the most important benefits. FGV Holdings Berhad has several categories of business operation. Segment reporting can disclose which areas are profitable and which are drains on the bottom line. Thus, the company's management can take various steps and initiatives to maintain the segment profitability while increasing the profit of the other segments. For example, the evaluation could prompt a change in strategic direction for the managers to make future decisions.
Last but not least, segmental reports are lower cost of capital. As we already know, the risk of investing in the stock of firm that reveals all information is theoretically lower than the risk of investing in the stock of a company that withholds information. For example, when the company faces financial risk problem, our company's cash position and liquidity as well as working capital requirement were closely monitored and assessed, and appropriate strategy were undertaken to address emerging liquidity pressure. That's all from me. Thank you.
However, there are certain disadvantages that need to be highlighted, which are data manipulation. Information segmental reporting can be manipulated and presented in the way that management wants. By presenting data through the eyes of management, segment reporting lends itself to manipulation. Therefore, financial statements may present an inaccurate picture of a company's performance. The loss could be grouped with an unrelated profitable business unit to paint a better picture of performance to deceive the board of directors. Next, the other disadvantages is placing a strong emphasis on the present. Segment reporting can place too much of focus on short-term numbers. In spite of knowing this can affect their business in the long run, companies report their segments using short-term data and neglect the long-term figures. Lastly, base of segmentation. The split of diversified organizations for segment reporting purposes is a basic challenge that emerges in segment reporting. Segments can be created in a variety of ways depending on the segmentation base. Segmentation can be done based on organizational divisions, industries, markets, and products, among other things. Each base has its own set of limitations and issues.
Hi, my name is Ainur Akila binti Mat Bakri. We'll continue in part BA basis of preparation of interim report. The group and the company financial statement have been prepared in compliance with Malaysian Financial Reporting Standard (Mfrs), International Financial Reporting Standard (IFRS), and the Government Companies Act 2016 regulations. When preparing the financial accounts, the group and the company took into account the effect of the COVID-19 epidemic as well as the present business climate. The company's directors still believe it is acceptable to prepare the financial statement on a going concern basis, unless otherwise stated in the particular policy statement in Note 3 to the financial statement. The financial statement of the group and the company have been produced using the historical cost convention. Next, the use of specific critical accounting estimate and assumption is necessary for the preparation of financial statement in accordance with MFRS. This assumption and estimate have an impact on the reported amounts of asset and liabilities as of the date of the financial statement, the disclosure of contingent asset and liabilities, and the reported amounts of revenue and expenses for the reporting period. Additionally, it allows one director to use discretion while implementing the group and company accounting principle. Although the director have made their best judgment and estimation based on current circumstances and activities, actual outcome might vary. Note 5 contain information about the areas requiring a greater level of judgment or complexity, or areas where assumption and estimate are important to the financial statement. Okay, let's proceed to the following slide. I will explain two accounting policies that used in preparing the interim report. First, leases. Leases are recognized as a right of use asset and a corresponding liability at the date at which the leased asset is available for use by the group and the company. The group initially estimate and recognize amount expected to be payable under residual value guarantees as part of the lease liability. The amount are reviewed and adjusted if appropriate. At the end of each reporting period, a change in lease payment, other than those arising from a change in amounts expected to be payable under residual value guarantees or in an index or rate used to determine lease payment, is accounted for as a lease modification if it is not part of the original terms and conditions of the lease. The lease modification is accounted for as either a new lease or as a remeasurement of an existing lease liability, depending on the criteria set in MFRS 16. Second, property, plant and equipment (PPE) are initially stated at cost. All PPE are stated at cost less accumulated depreciation and impairment losses. The cost of an item of PPE initially recognized include its purchase price and any cost that is directly attributable to bringing the asset into the location and condition necessary for it to be capable of operating in the manner intended by the management. Costs also include borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset. See significant accounting policies. Note 3I on a borrowing cost. To the extent a legal or constructive obligation to a third party exists, the acquisition costs include estimate costs of dismantling and removing the asset and restoring the site. Subsequent costs are included in the asset carrying amount or recognized as a separate assets as appropriate only when it is probable that the future economic benefits are associated with the item will flow to the group and the cost of the item can be measured reliably. The carrying amount of replaced parts are recognized. All other repairs and maintenance are charged to profit or loss during the financial period in which they are incurred. Major spare parts, standby equipment and servicing equipment are classified as PPE rather than inventory when they are expected to be used during more than one period.
Thank you, Aino, for a great explanation of segment reporting. Next, I would like to explain more about the types of interim reports of SGB Holdings Berhad. SGB Holdings Berhad provides 4 types of statement: a statement of financial position, a statement of profit or loss and comprehensive income, a statement of changes in equity, and statement of cash flow. As we can see, SGB Holdings Berhad uses quarterly interim reporting, which is issued every 3 months a year or 4 times a year. The first quarter of interim reporting period started in January 2021 and ended in March 2021. The second quarter started in April 2021 and ended in June 2021. The third quarter began in July 2021 and ended in September 2021. Lastly, the fourth quarter started in October 2021 and ended in December 2021. Following that, I will continue on the period of the company's current and comparative financial statements. As you can see, here is the current interim report and comparative of each statement prepared by FGB Holdings Berhad. Moving on to the first statement, which is the statement of financial position. The current interim report is prepared from 1 October 2021 to December 31, 2021. Whereas the comparative report is prepared from January 1, 2020 to December 31, 2020. The current interim reports, profit and loss statement, and statement of comprehensive income began on October 1, 2021 and ended on December 31, 2021 for a period of 3 months, followed by the cumulative, which began on January 1, 2021 and ended on December 31, 2021 for a period of 12 months. On the other hand, the comparative it started on 1 October 2020 until 31 December 2020 for a period of 3 months, and followed by cumulative which began on 1 January 2020 until 31 December 2020 for a period of 12 months. Following that, I will continue on the period of the company's current and comparative financial statements. As you can see, here is the current interim report and comparative of each statement prepared by FGB Holdings Berhad. Moving on to the first statement, which is the statement of financial position. The current interim report is prepared from 1 October 2021 to December 31, 2021. Whereas the comparative report is prepared from January 1, 2020 to December 31, 2020. Finally, the statement of changes in equity and the statement of cash flows cover the same time period as the current interim and comparative reports, January 1, 2021 to December 31, 2021 and January 1, 2020 to December 31, 2020. Now, we move to the last section, which is adjustment made by the company to be included in the interim reports. There are 2 adjustments made by the company, which are on inventory and account receivables. Firstly, on inventory, the cost is Rm 40,046,700 and the net realizable value is 45 million. In determining the value of inventory, we need to compare and choose the lowest between the cost and the net realizable value. Since the NRV is the lowest, it will be adjusted on the statement of financial position in December 2021. Okay, now I will pass it back to Aino for the last slide. Thank you.
Next, adjustment number 2. As at 31st December 2021, the company vacated a building. On the same date, the building had a carrying amount of Rm2 million. Thus, the building have a fair value of Rm2.8 million. Upon vacating, the building as lessor entered into a 5-year operating lease agreement. The entity measure property, plant and equipment PPE using a cost model and investment property using a fair value model. Below is the journal entry. Debit investment property Rm2 million, accumulated depreciation 400,000 and credit PPE Rm2.4 million. Next, debit investment property Rm800,000, credit asset revaluation reserve Rm800,000. Thank you.